Welcome to the webinar, Critical Minerals, Is it an Opportunity Worth Chasing? My name is Abhirab Basu. I'm a senior analyst here at Lux Research, and I will be moderating today's session. Presenting today is my colleague Ian Reinhardt, Associate Director, Research Director at Lux Research. Throughout the webinar, you can type any questions you have in the questions box on your screen. Time permitting, we will answer all the questions that we can. If your question doesn't get answered, please don't hesitate to email it to questions@luxresearchinc.com, and we will respond. If at any point you experience technical difficulties, such as a frozen screen, simply refresh your browser and check that your internet connection is strong. Now, let's jump into the presentation. Ian?
Great, thank you, Abhirab. So before I get into our latest research, I want to take you back in time to talk about a critical raw material of the past, whale oil. In the 1800s, burning whale oil in lamps was a common form of illumination for the middle class, even better than candles. Whaling fleets went around the oceans of the world, hunting whales and processing their oil. But the more that they hunted the whales, the fewer there were to hunt, and this enterprise became less efficient and less profitable. Around the same time, natural hydrocarbons began displacing whale oil in the market. And as whale stocks really went into decline, petroleum production began to scale up. But ultimately, what became the default source of illumination was, of course, electricity and the light bulb, that iconic symbol of invention. At the end of the day, consumers want light. In this case, a resource shock led to change in which innovations resolved the shortage of the raw material. So as you consider the paths available to you, I want to ask, are you hunting whales or are you working on a light bulb? In today's webinar, I'll first set the scene with important policy and economic context. Then we'll explore Lux's raw materials criticality framework, how it works, and more importantly, what it tells us. Then we'll use the framework to dive into 4 innovation strategies that mitigate risk and put your company on a resilient path to growth. And of course, wrap up with key takeaways. So first, the context. When we look at critical raw materials, the topic that tends to dominate is, of course, critical minerals. These materials like lithium, rare earth elements, and platinum group metals, energy transition, and will become even more important. However, production is heavily concentrated in just a few countries. The top 3 producing countries account for 80% or 90% of supply in most value chains. And that's only for the initial extraction step. Those orange diamonds overlaid on the bars show the percentage of refining that takes place in China. That stage is also highly concentrated. China refines 65% of all lithium, 75% or 70% of cobalt. The world needs these minerals and reliable supply chains to accelerate the energy transition during a difficult economic period. But the trend is in the opposite direction. The international system of free trade is disappearing. Governments view resources as national power, and conflict only makes the problem worse. For example, the deal that US and Ukraine negotiated to give access to critical minerals, it's a very old school way of thinking. We give us your mines and we might protect you. Countries are returning to old ways of working. And it's not about efficient, low friction markets anymore. It's realpolitik, hard power. And that creates problems for the private sector. The nickel supply chain is a clear example of this dynamic. Indonesia used to export a lot of nickel ore, but the government thought, let's use our market power and low cost base to onshore more refining activity and grow value-added industries. In 2020, Indonesia banned the export of nickel ore, causing an inflow of investment for refining capacity. Indonesia now supplies 60% of the global market for nickel metal. But the really big player is China. I showed you the chart earlier. Even in supply chains where China is not the top producer, 50% or 70% of refining takes place there. And even in the overseas supply chains, all that new nickel refining capacity that's spurring up in Indonesia, it's Chinese companies that are building that. And it's not just raw materials either. China has used its leverage has created leverage by banning the export of things like lithium adsorbents and the actual technology and precursor materials required to extract and refine critical metals. Now, on the other hand, countries who import these materials are doing what they can to offset the market leverage, but they're playing with a weak hand. Perhaps you saw the news about the Trump administration's Project Vault. That's a $12 billion initiative to stockpile a reserve of critical minerals that companies can buy into and participate to aggregate their demand and purchasing power. The US has also taken the relatively rare step of taking equity investments in startups to ensure that they'll develop the critical technologies that can help onshore more supply. The EU has organized a new buyers club called the Raw Materials Mechanism. That's a vehicle to consolidate and coordinate critical minerals purchases, again, to give more negotiating power. But until these countries can onshore more production or obtain control of upstream assets, the effects will be limited. And what about the energy sector? Upstream activity, especially in lithium production, tends to grab headlines, but that's not the full picture. Energy companies are also directly involved with projects to scale up new technology for mineral recovery. For example, new membranes to extract minerals from produced water, or valorizing lithium from brines and geothermal power projects. Downstream, energy companies are commissioning facilities to produce green hydrogen, to capture and sequester CO2. For those activities, they're the customer, buying electrolyzers, sorbents, compressors, and so on. And therefore, they need to consider the supply chain for all that equipment. This is the context in which these sectors are operating. It's not obvious where the biggest risks and best opportunities are, and that's why you need a framework. So I'm pleased to share with you today the Lux Raw Materials Criticality Framework. Let me explain how it works. This is what the chart looks like for solar photovoltaic power, solar PV. When you use the framework, you analyze a defined product or system over a period of time. For this presentation, I'm using projections from the IEA's net zero energy scenario for 2050 to analyze the required materials for scaling up the products and systems in the energy transition over the next 25 years. Each dot is one of the key material inputs like silicon, aluminum, copper, etc. So what is this chart telling us? Framework shows two values. On the vertical axis, supply risk. That's a measure of the resilience of the raw material supply chain based on the spread of producing countries, whether it's very few or very many, and then the stability of those countries themselves. It's a composite score that uses the World Bank's governance index on a weighted basis and a mathematical calculation of the concentration of production in, as I said, either very few or very many countries, where higher supply risk indicates very few countries. There could be bottlenecks. On the horizontal axis, you have criticality. This is a measure of the raw material required to meet that projected deployment over the time period that you've defined. And that total stock of material over the entire time divided by 1 year's worth of total global production is the criticality score. So it's a ratio measuring the balance of supply and demand, where a higher criticality score indicates likely issues with total supply in the future. So breaking that down again, if you see a dot on the top half of the chart, that indicates high supply risk. More volatility here, subject to unpredictable disruptions because there are fewer countries producing it. So if there's an incident, conflict, or government change, that could cut off supply in unpredictable ways. On the bottom part of the chart, you have low supply risk. Of course, there's a distributed, diversified supply of this material. It can be sourced from many different countries, and the countries that do supply it tend to have stronger governance and are more stable. Similarly, when we look at dots on the left side, that's low criticality. You should be less concerned about total supply for this material, as there's likely to be enough for that projected scenario in the future. On the other hand, dots on the right, you should be concerned, especially with higher scores, 5, 10, 20. A score of 25 here means that over the next 25 years, it will take all of the world's production of this material every year for that entire time to provide the supply. So obviously that's not going to happen. And you'll probably notice that the scale here is logarithmic. It's orders of magnitude. So it's not so important to be caught up in precision. It's not like 2.3 versus 2.6 really matters. But if you see that number creeping to 5 and 10 and beyond, that indicates real challenges and very unlikely for total supply to meet demand in this future scenario. So you can also think about the chart in terms of quadrants. On the top left, that would indicate supply volatility. Overall, there should be enough of this material to meet projected demand, but it's subject to unpredictable disruptions because of that concentration in few suppliers with weaker governance. In the lower left, long-term stability, that's where you hope to see when you're plotting the projected systems and products using this framework. Good supply-demand balance and less volatility. Top right, growth limitations. This is the most concerning quadrant where you're facing both the challenge of total supply-demand balance as well as that unpredictability due to high supply risk, few producing countries with lower governance scores. Then in the lower right, we call it impending shortages. Although the supply is diversified and you don't have to worry about disruption in the same way, there just may not be enough of the material. The current forecasts for the economy are that we will not be producing enough of that critical mineral. Okay, so what do we do with that information? What do we do now? You need to turn the framework into action. In the next section, we'll review 4 innovation strategies with examples and historical precedents to inspire us. The first step is, of course, to plot the products you sell or the equipment you buy on the framework. The location of the dots and which materials are where will point you in the direction of one of these overarching strategies. And you'll notice that there is not one arrow from each quadrant to a particular strategy. It's not a one-to-one mapping like that, although there are strong correlations. The reality is that a particular strategy may work well for multiple materials or multiple quadrants. You need to examine the chart first to determine the best approach or approaches. So let's do that. This is the chart for solid oxide electrolyzers for the production of green hydrogen. The good news is that criticality is quite low for all of these. In aggregate, there should be plenty of the required material to produce this type of electrolyzer. But you'll also notice that silicon, yttrium, and lanthanum lie above the center line in the quadrant of supply volatility. The production of these materials is concentrated in just a handful of countries where the quality of governance is lower. Your supply chain will be subject to unpredictable disruptions. We're facing these supply shocks right now in gas, aluminum, and fertilizer due to the blockage of the Strait of Hormuz. Now, the operations group in your company can stockpile those materials, sure, that's a good start, but what can you do in the innovation function to mitigate this risk in the coming decade? Develop novel sources, innovations that supply critical raw materials from wastes or untapped resources. The clearest near-term opportunity is in extracting high-value materials from industrial wastes. That's an area where energy companies can directly participate. This picture on the left shows a pilot project for critical mineral recovery from produced water in the Permian Basin. Advancements in membrane technology make it possible to economically valorize the minerals in these highly complex waste streams. The second example in the middle, deep sea mining, is controversial, yes, but it's exactly the type of high-risk bet that companies should make periodically. It's well known that there are trillions of dollars worth of critical minerals in nodules on the seafloor, but one, the technology to extract them is immature, and two, there are very real concerns about the environmental damage, which could be significant. This is a challenge for technical innovation. I think it could be possible for advancements in robotics and AI to carefully, precisely harvest these minerals while minimizing the damage to the undersea habitat. Now on the right, you have an even more exotic example, phytomining. That's genetically engineering plants to harvest certain or extract certain metals from the soil as they grow. Then you harvest the crop and concentrate the metals in bulk. Seems a little crazy maybe, but last year a startup raised $45 million to pursue this technology. So it could be worth exploring. Now, as I said at the start of this section, we decided to bring in a few historical examples to inspire us. This innovation strategy has been done before. In the 1800s, as manufacturers began to appreciate the properties of aluminum, the only mineral source was cryolite, mined in Greenland, and therefore aluminum was more expensive than gold. But thanks to a breakthrough innovation, the Hall-Héroult process, it became possible to extract alumina from bauxite, which is practically everywhere. And now aluminum is one of the most common materials in the world around us. Okay, let's use the framework with another example, alkaline electrolyzers. another way to produce green hydrogen. But here you only have silicon over the line and the other raw materials pretty comfortably in the stable quadrant. This is the happy place. But that doesn't mean you should take a nap. There are opportunities here too. Material optimization. Can you get more value with less material? Often catalysts are the main need for scarce materials like iridium. Lux has interviewed several material informatics companies that have tailored solutions to discover novel catalysts. Here on the left, you see a picture from the startup Matic that uses a lab-on-a-chip approach to accelerate R&D for that application. Creating efficient structures is another pathway. Here in the middle, I'm taking inspiration from a food product. That image you see in the center is sugar, but the sugar is produced in such a way that the tiny crystals are hollow, as you can see in those bubbles. The tongue experiences the same amount of sweetness, but you're ingesting about 30% less sugar, which is good for your health. Could you apply that same principle to your products? Then on the right, thin film deposition, a relatively mature technology, but one with the scope to expand to more applications. And turning back the clock, the mandate for catalytic converters and on cars had a welcome impact on air quality. But as it rolled out in the late 1970s, automakers were stuck with heavy bills for all that platinum. Companies eventually solved that challenge with R&D, developing blended catalysts that replace most of the platinum with lower cost materials, rhodium and palladium. Okay, great. Now for the scary corner. This is the chart of NMC batteries, which feature significant levels of nickel, manganese, and cobalt. All of the critical raw materials have concerning criticality scores, but graphite and cobalt are in the top right. Cobalt almost defines the corner. Global production is unlikely to provide sufficient cobalt supply over time. And even then, there's mainly one source country with very poor governance. Real problems ahead, and yes, producers are already adjusting their plans. But graphite is also a very interesting case. Over 95% of lithium-ion batteries today use graphite, and 97% of the world's supply is handled by China. The Trump administration placed 220% tariffs on graphite imports to spur onshoring, but China retaliated with its own export quota, and all that's really done is put battery producers in a huge bind. So clearly there's a strong case for domestic graphite production, but can it scale up quickly enough to replace imports? And I should also note here that we've done the same analysis, and not only with a net zero energy scenario, but more pragmatic scenarios that just feature announced deployments, and it's a very similar picture. So what should you do? Look for alternatives. Are there other materials that can provide the same function? Now, in the case of batteries, there are a lot of chemistries that store electrical power, and Lux has published a body of research on novel battery chemistries and others challenging conventional lithium-ion. But this strategy applies to other products. The startup Niron Magnetics is developing permanent magnets that don't require exotic rare earth elements. It's pictured on the left. Synthetic replacement is another approach. Can you produce a materially similar product through another production pathway? Several startups are commercializing bio-based concrete, which relies on bacteria or microalgae to produce a binder instead of cement. That will be a very different value chain. Synthetic graphite, a more conventional example, but as I mentioned, a strong case for investment. And then the third idea here is somewhat obvious, but bears mentioning. Steer clear. Don't do it. We're already seeing that with NMC batteries. Companies are winding down those product lines. And to take it one layer deeper, it's valuable to run this analysis with your customers' key products. Are you producing cell packs or control electronics for NMC batteries? Then you're in trouble. You can use the framework to predict how a category will shift over time, which technologies will be losers and winners within that market. Looking to history for inspiration, one of the most iconic synthetic products is rubber. Up until World War II, most rubber production was from a natural raw material. When Japan cut the US off from its rubber supply in Southeast Asia, there was a massive R&D effort to produce a synthetic alternative, which led to the styrene butadiene that's most common in tires today. Now let's look at our fourth example, solar photovoltaic power. Silicon is in the top right. Then we have three metals in the lower right with problematic criticality scores. These points tell us that there could be shortages unless production ramps up or innovation reduces demand. In the middle, two commodities, steel and concrete, with potential supply concerns. Now, it may seem odd to put such basic materials on the chart, but Especially in 2021 and 2022, as economies were returning to normal after the pandemic, we often heard from innovators or corporates scaling up new pilot projects that the bottlenecks were just getting basic materials like pipes to build facilities. So these materials can be a challenge as well. The fourth strategy, recycling and circularity, seeks to avoid shortages by making the most of available materials. One approach here is to develop your own novel recycling technology or invest in startups that have complementary technology. This approach is most impactful for rare earth elements and EV battery materials where the core recycling technology is immature. The prototype reactor here on the left is a British project for rare earth recycling. The second approach is simple and very powerful, but also extremely difficult to do well, and that's redesigning your products for circularity. This image in the middle is a BMW concept car that, instead of adhesives in the seat assembly, has a threaded wire harness. So at the car's end of life, you simply unlock and then pull out the threaded wire harness, and then all the components separate cleanly. You get metals, polymers, textiles, all ready for complete recovery or reuse. So to reuse and fully recycle the materials in your products, you need to rethink the attachments and use more monomaterial pieces. And third, business model innovation can play a huge role here. In so many cases, it's the collection step that's the most difficult. Can you create efficient logistics among partner organizations and create the right incentives to gather and centralize these materials for recycling? Collection logistics are often a make or break factor. Now, we can easily take recycling for granted, but it wasn't until the middle of the 20th century that steel recycling became mainstream. The invention and development of the electric arc furnace led to the growth of mini mills and secondary steel production. That innovation is a foundational element of all modern economies. Can your company pioneer a similar breakthrough? Okay, we looked at all four strategies which derive from the analysis of the Lux raw materials criticality framework. The location of the dots for the materials in our products leads us to emphasize one or more of the four strategies, depending on whether we're concerned about supply shortages or volatility or both. Now, these aren't mutually exclusive. You can pick and choose elements of each. The point here is that you have a toolkit of strategies. And when you understand your critical raw materials, you'll minimize the risk. Carrying out that strategy will put your future growth on a foundation of resilience. And that's our shared goal. Reviewing the key points from the presentation, first and foremost, use the strategies and approaches that I've described to build resilience. The right investments, R&D projects, and partnerships will address the particular supply risks that your company faces. Second, it's not only the more exotic materials like yttrium and iridium that create bottlenecks. For systems with large infrastructure requirements, commodity materials like steel and concrete can have high criticality scores. And third, monitor the competing approaches to solve the same problem. Several different types of water electrolyzers can produce green hydrogen. The separation of winners and losers in that market will alter future material demand expectations. Okay, well, for that, thank you very much for your attention. And now I think we'll have time for a few questions.
Yeah, that was great. Thanks, Ian. We will now be taking questions that you may have on the presentation, which you can type into the questions box. If we do not get to your questions on this call, someone from Lux will be in touch after the webinar. All right, why don't we take some questions from the audience? And while we're waiting for those questions to come in, I'll keep an eye out on those. Ian, why don't we start with something that I have, a quick question
Sure.
for you. We saw a lot of technologies that can face supply risk, can have criticality issues in terms of the amount of materials that those technologies need. So if mineral access continues to remain constrained in the future, do you think material availability would be a bigger bottleneck than, say, something like funding, access to capital, or even policy for the energy transition, especially?
Mm-hmm. Well, I think there it depends on the system that you're talking about. So for the energy transition, there are a category of solutions that are really policy dependent. And I'm thinking about things like carbon capture and sequestration. That's a market that essentially you need policy to create the business case, whether that's through an emissions trading scheme or tax credit or subsidy or something. And so that will continue to be the core factor. On the capital side, we're definitely in a bit of a low ebb for climate tech compared to 3-4 years ago. But nevertheless, projects are moving forward, and especially those that can stand on their own 2 feet that don't require policy to make the business case. So that leaves for that category the material supply issue, and there I do think there will be maybe not the majority of different projects, but as we've seen through this analysis, a handful of different types like PEM electrolyzers and others where a particular material requirement like iridium, for example, is really going to curtail the scale up of that, and that we need to be mindful of that. If there's no innovation to solve that in the medium term, then ultimately it's going to be the limiting factor. Yes. So it's kind of case by case, and that's why the framework helps.
Yeah, that's a great point. I think we've done quite a bit of work on green hydrogen and the criticality around those, and PEM is a great example where there can be a growth limiting aspect to that technology. And I do see a couple of questions coming in. Maybe one on alternative technologies, which kind of lines up well with what you were just saying. Do you expect mineral constraints to accelerate the adoption of alternative technologies, like an alternative to PEM, for example? There's a good one over there. Or do you expect that because there's less access to these minerals and metals, deployment overall is going to be slower?
I think more of the former. So I guess the comparison here is it will this kind of cap market growth, or will there be other directions that companies take? And there what I think probably a key example would be like LFP batteries. For I mentioned NMC batteries. So already, because mainly of cobalt, companies are not trying to put too much weight on that for their growth plans, and thinking about using more commodity, distributed, easily available, low-cost materials, and that's why LFP or even like sodium-ion batteries can also be a bigger part of the energy transition in the future. So I do think that it's a matter of finding the right balance rather than that simply being a blocker. Innovation has a way of working through those challenges, and that's a key theme for the presentation.
I see a couple more questions. We probably have time for one more. This is one from, I'm sure this is someone from the chemicals industry. Where do you see the biggest opportunities for materials producers, chemical manufacturers, to find new market opportunities? Is it things like material substitution, finding new extraction methods, or recycling technologies?
Sure. Well, if I think about that in terms of the sequence of opportunity there, it's going to be different on different timescales. So, especially in the Western world, EU, United States, there's a lot of urgency to resolve this problem now. And I talked about some of that in the context, the pressure for onshoring. So what's going to create impact in the near term will be recycling. That's usually the quickest way that you can make a dent in imports and start to onshore more production, is taking advantage of the materials that are already in circulation. That can be a part of the solution in the next 3, 4, or 5 years. So I would encourage companies to look at that. There's always been a lot of activity in rare earth recycling, a lot of investment, and starting to see companies get to first of a kind commercial scale facilities. I think that's a really good near-term opportunity. But yeah, in the medium to longer term, that type of synthetic replacement, material alternatives, is really attractive, and it pairs well with advancements in R&D and the ability of material informatics to accelerate that and to identify and much more efficiently and progress through the early stages of R&D these alternatives. That it's not only will this material have the properties you want, but even the latest the latest material informatics solutions are also looking at synthesizability. So they're helping you tackle those manufacturing challenges in advance. So yeah, I think synthetic alternatives for the really high volatility materials. I mentioned synthetic graphite as another example in the talk.
Yeah.
Like, yeah, there's a lot of a medium term opportunity there, but it's just not that quick. It's going to take time. So that's more like a 2030s bet.
Great. That's all the time we have for questions. Thank you, Ian. That was a great presentation. That concludes our webinar for today. The slide presentation and recording from this webinar will be sent to all attendees via email today. After leaving the webinar, you will be prompted to complete a survey on today's presentation. We would appreciate any feedback you may have to help inform and improve our future webinars. Take a moment and check out our upcoming webinars on the Lux Research website. That's it. Thank you for joining us and have a great day.
Thank you.